At 7:18 a.m. on a Wednesday morning in November, the Aurora Grand Casino's automated reconciliation system completed its overnight audit cycle and displayed the standard green status confirmation across all departmental dashboards. Financial controllers in the main office reviewed summary reports showing cash flows, gaming outcomes, promotional disbursements, and operational expenses. Everything reconciled within expected variance ranges. Department heads signed off electronically, confirming that their areas of responsibility showed no discrepancies requiring escalation or review. The overnight shift supervisor, completing his final checklist before the day crew arrived, glanced at the master dashboard displaying hundreds of data points representing the casino's operations over the previous 24 hours. Green indicators across every category, no alerts, no flags, no anomalies, standard overnight closure, nothing remarkable. At 9:47 a.m., a junior auditor named Emily Chen was conducting what she privately called curiosity checks, optional review procedures that weren't technically required, but which she performed because she had been trained to never fully trust automated systems. She was comparing transaction totals between two different reporting systems that should theoretically show identical numbers: the gaming floor's player tracking database and the accounting department's cash reconciliation ledger. The numbers didn't match, not dramatically, not in ways that would trigger automated alerts. Just a small discrepancy, 1/840 across thousands of transactions. The kind of variance that could easily be attributed to timing differences, processing delays, or rounding in different systems. But Emily had been taught in her auditing courses that small discrepancies were sometimes symptoms of larger problems. She began tracing the variance backward through transaction logs, looking for the source. 3 hours later, she was sitting across from the casino's chief financial officer with a spreadsheet showing something that shouldn't have been possible. Over the previous 14 months, similar small discrepancies had been accumulating in a pattern that suggested systematic rather than random variation. When aggregated across that time frame, the cumulative variance wasn't 1,947. It was $49,000. "I must be making an error in my analysis," Emily told the CFO, her voice uncertain. "The numbers show that we've paid out $49 million more than our gaming outcomes and promotional budgets should have authorized, but every individual transaction was approved by our systems. Every payout was authorized. The math doesn't work unless—" She trailed off, not wanting to articulate what the data suggested. The CFO finished her sentence. "Unless someone found a flaw in how our systems calculate payouts and exploited it consistently over more than a year." By end of business that day, after emergency reviews by senior accounting staff, external auditors, and the casino's security director, the impossible was confirmed. $49,000 had been systematically extracted from Aurora Grand Casino over 14 months through transactions that were individually approved by automated systems, properly documented in financial records, and seemingly compliant with all posted gaming rules. No forced entry, no hacked computers, no insider collusion, no obvious fraud. Just someone who had apparently discovered a mathematical error in how the casino's systems processed certain types of gaming activity, and who had exploited that error with accounting precision. The investigation would eventually trace the activity back to a player profile belonging to Aaron Liu, a 24-year-old night school accounting student who worked days as a data entry clerk, studied evenings at a community college, and had no prior gambling history or criminal record. He had simply noticed something that decades of casino operations, millions of dollars in security systems, and teams of financial professionals had missed. A rounding error in how certain promotional calculations were processed, so small in individual transactions that it was invisible to oversight, but which compounded over time when exploited with consistency and discipline. And by the time anyone realized the error existed, Aaron Liu had already graduated, paid off his student loans, and disappeared from the casino's records. Aaron Liu was 24 years old and invisible in the way that people living on tight margins often are. Present in spaces but not particularly noticed, moving through systems without creating ripples. He worked 40 hours per week as a data entry clerk at Sterling Insurance Group, a regional insurance company occupying 3 floors of an office building in the financial district. His job consisted of transferring information from paper claim forms into digital databases, verifying that entries matched source documents, and flagging discrepancies for review by claims adjusters. The work was tedious and poorly paid, $16.50 per hour, which came to approximately $2,140 monthly after taxes. His rent consumed $1,100 of that. Utilities, phone, transportation, and food consumed most of the rest. What remained went toward tuition for the evening accounting program at Metro City Community College, where he was 3 semesters into a 2-year associate degree. Aaron attended classes 4 nights per week, arriving at 6:30 p.m. after his insurance job ended, and sitting in classrooms until 9:45 p.m., learning financial accounting, cost accounting, auditing principles, taxation, and business law. He typically reached his studio apartment around 10:30 p.m., spent 2 hours reviewing coursework and completing assignments, and slept from 1 a.m. to 6 a.m. before repeating the cycle. His instructors knew him as someone who asked precise questions and caught errors in textbook problem sets. Not the printed answers, but the problems themselves. He once identified that a cost accounting problem in the official textbook contained an error in its underlying assumptions that made the correct answer technically incorrect. The instructor had verified Aaron's analysis and submitted a correction to the publisher. Aaron saw numbers differently than most students, Professor Margaret Chen would later tell investigators. Most people learning accounting treat it like following recipes. Do these steps, get this answer. Aaron treated it like detective work. He wanted to understand why the numbers worked the way they did, what assumptions were embedded in formulas, where the edges of accuracy were. His classmates barely knew him. He didn't socialize, didn't attend study groups, didn't participate in the accounting club or professional networking events that career counselors recommended. He arrived for class, sat in the same seat near the back, took meticulous notes, and left immediately when sessions ended. His co-workers at Sterling Insurance found him equally unremarkable, quiet, reliable, fast at data entry, but not remarkably so. He took his lunch break alone, eating food he brought from home while reviewing textbooks. He never attended happy hours or company social events. The only thing people noticed about Aaron was his accuracy. In 18 months of employment, his error rate in data entry was 0.03%, meaning he made approximately 3 errors per 10,000 entries. The department average was 2.1%. His supervisor once asked how he maintained such consistency. "I assume I'm wrong until the numbers prove otherwise," Aaron had replied. "Most errors come from trusting that things are correct. I don't trust anything until it reconciles." This philosophy, assume error until proven otherwise, had been drilled into Aaron during his childhood by his father, an accountant at a manufacturing company who had lost his job when financial fraud at the company was discovered. The fraud had been possible, his father explained, because auditors had trusted that reconciliation systems were accurate rather than verifying them independently. "Numbers don't lie," his father had told him repeatedly, "but the systems we use to process numbers can be wrong. And if a system is wrong consistently, it creates patterns that look like they're right until someone actually checks." Aaron had internalized this lesson completely. He trusted nothing without verification. He assumed every system had flaws. He looked for discrepancies that others overlooked because they assumed accuracy. This mindset made him an exceptional accounting student and a meticulous data entry clerk. It would also make him exceptionally dangerous to any system built on assumptions that mathematical processes were inherently correct. Aaron's first visit to Aurora Grand Casino occurred during a weekend in February, motivated by nothing more than academic curiosity. He was enrolled in Professor Chen's advanced financial accounting course, where they were studying revenue recognition principles for hospitality and gaming industries. The textbook included a chapter analyzing casino financial statements, explaining how gaming revenue was calculated, how promotional allowances were accounted for, and how regulatory requirements influence reporting. The chapter included sample calculations showing how casinos determine player rewards based on theoretical loss, the amount a player was expected to lose based on house edge applied to total wagering volume. Casinos use these calculations to offer comps, complementary services, cashback rewards, and promotional credits designed to encourage continued play while maintaining profitability. Aaron had been studying these calculations when he noticed something that seemed inconsistent. The textbook's example showed a player wagering $10,000 on a game with a 2% house edge, generating theoretical loss of $200, which entitled the player to rewards worth 35% of theoretical loss, $70 in promotional value. But the actual calculation in the textbook showed the promotional value as $70.35. The extra 35 cents came from rounding. The textbook had rounded the 35% calculation to 2 decimal places before multiplying. 35% of $200 was technically $70, but the system had apparently calculated 0.35 x $200 are 70, then rounded the result. It was a trivial amount, completely meaningless in the context of a single transaction. But Aaron had immediately wondered, if this rounding happened on every transaction, and if players conducted thousands of transactions, did the rounding always favor the casino, or did it sometimes favor the player? More importantly, did casino systems track these micro-rounding discrepancies, or did they simply assume the amounts were too small to matter? It was a purely academic question, a curiosity about whether real-world casino systems handled rounding the same way the textbook example suggested. The following Saturday, Aaron drove to Aurora Grand Casino, the largest gaming facility within reasonable distance of the city, to observe how their systems actually worked. He brought $100 in cash, the most he could afford to spend on what he considered a research expense. He didn't intend to gamble seriously. He just wanted to watch transactions, see what information was displayed to players, and understand whether the systems showed rounding in player-facing interfaces. He spent 3 hours walking through the casino, observing gaming operations with the attention he normally applied to studying financial statements. He noticed that slot machines and video poker terminals displayed promotional calculations on screens when players inserted their rewards cards. He noticed that these calculations showed results to 2 decimal places. He noticed that those decimal places sometimes showed non-zero values. At 4:30 p.m., he sat at a video poker machine, inserted his newly created player's card, and began playing at minimum stakes, 0.25 per hand. He played slowly, methodically, watching not the cards but the promotional tracking display in the corner of the screen. After 50 hands, the display showed he had earned 0.73 in promotional credit based on his theoretical loss from wagering activity. Aaron pulled out his phone and opened a spreadsheet. He calculated what his promotional credit should be based on the game's published return to player percentage and the casino's stated reward rate. The number he calculated was 0.60 5 cents difference. Barely meaningful, but wrong. He played another 50 hands, tracking the promotional credit accumulation. Again, the displayed amount was higher than his calculated theoretical value. Aaron left the casino that evening having lost $23 of his original $100, which was consistent with the expected house edge. But he left with something more valuable than the $70 remaining, a hypothesis. The casino's promotional calculation system appeared to have a rounding error. Something in how it calculated fractional promotional credits was producing values slightly higher than theoretical models would predict. Not enough to be obvious on any single transaction, but consistent enough to accumulate. And if the error was consistent, it could be exploited through disciplined, repetitive play that maximized the number of transactions rather than the size of individual bets. Aaron spent the next 6 weeks treating the casino promotion system like a homework problem, something to be solved through careful analysis and verification. He returned to Aurora Grand 6 times over this period, always on weekends, always with small amounts of cash he could afford to lose. Each visit followed the same protocol. Play at minimum stakes to maximize number of transactions. Track promotional credit accumulation precisely. Compare actual credited amounts to theoretical calculations. Document any discrepancies. He also studied everything publicly available about Aurora Grand's promotional system. The casino's website explained their rewards program in marketing language. Players earned grand points based on play, which could be redeemed for cash, services, or merchandise. The conversion rates were published. 100 grand points equaled $1 in redemption value. What wasn't clearly explained was exactly how grand points were calculated. The website said points were based on your theoretical loss from gaming activity, but it didn't provide the actual formula. Aaron began reverse engineering the formula through systematic observation. He played different games with different house edges. He varied his bet sizes. He tracked everything in spreadsheets. After 6 weeks and approximately $340 in total gambling expenditure, Aaron had identified the pattern. The casino's promotional system calculated grand points using a multi-step process. Calculate theoretical loss, total wagered, X, house edge percent. Calculate promotional percentage, base rate, plus tier bonus based on player status. Calculate promotional value, theoretical loss, X, promotional percentage. Round promotional value to 2 decimal places. Convert to grand points, promotional value, X 100. The error was in step 4. The system was rounding the promotional value up to the nearest cent before converting to points. This meant that any fractional promotional value between X2 and X01 was rounded to X01 rather than truncated to X0. On a single transaction, this created a maximum overpayment of 0.01 or 101 grand point. Trivial. But Aaron calculated that if someone played consistently at minimum stakes, generating thousands of small transactions rather than fewer large ones, the cumulative rounding error could compound significantly. A player making 1,000 small bets might receive 300, 400 extra grand points from rounding errors across those transactions. That translated to $3-4 in overpayment per 1,000 hands. Still seemingly trivial, but Aaron recognized something that casino financial systems apparently didn't. If someone played millions of hands over extended periods, maintaining disciplined minimum stake play specifically to maximize transaction count, the rounding error would accumulate into substantial amounts. The casino's automated reconciliation systems were designed to flag large individual discrepancies, not small systematic ones that only became visible in aggregate. Aaron did the math. If he played 500 hands per hour at minimum stakes over extended sessions, generating maximum transaction count, the rounding error could compound into thousands of dollars monthly. And since the promotional credits were being calculated and awarded by the casino's own systems, following their own published formulas, there was no rule being violated. The casino was giving him exactly what their system calculated. The fact that their system's calculation had a mathematical flaw wasn't his error, it was theirs. In accounting terms, this was called finding a material weakness in financial controls. In Aaron's mind, it was simply catching an error that auditors should have found years ago. He made a decision that would eventually extract $49 million from Aurora Grand Casino. He would treat exploiting this rounding error as a full-time job, executed with the same discipline and precision he applied to his accounting studies. Aaron's exploitation of the promotional rounding error began in month 3, after he had verified his hypothesis thoroughly enough to proceed with confidence. He established protocols that treated the casino like a workplace rather than entertainment. Schedule: visit casino 6 days per week, playing 4-hour sessions during overnight hours when the facility was less crowded and machines were more available. Game selection: video poker at minimum stakes, Auditor at 25 per hand, which offered optimal combination of fast play speed, low variance, and maximum transaction generation. Play methodology: mechanically optimal strategy, executed without deviation, designed to achieve maximum hands per hour rather than maximum win rate. Promotional tracking: meticulous documentation of grand points earned, comparing actual accumulated amounts to theoretical calculations. Verifying the rounding error remained consistent. Financial discipline: fixed bankroll per session, fixed stop-loss limits, no deviation regardless of outcomes. Treat the entire operation as a job with predictable income from promotional accumulation rather than gambling with uncertain results. Aaron quit his insurance job after 3 months of successful implementation, once he had verified that his promotional income exceeded his previous salary. He calculated that playing 2,000 hands per day, 6 days per week, generated approximately $4,800 monthly in promotional credits from the compounding rounding error, nearly double his previous employment income. To casino monitoring systems, Aaron appeared to be an unusual but not suspicious player. someone who played at minimum stakes for extended hours, apparently for entertainment rather than profit-seeking. His actual gambling outcomes were consistent with expected house edge. He lost small amounts on actual gaming, but his losses were more than offset by promotional credits accumulating from the volume of his play. Security personnel reviewing player behavior flagged him only once, noting extended low-stakes play, possible slot club advantage player, but concluded he posed minimal risk since his total gaming volume was modest in absolute terms and his promotional earnings fell within normal system parameters. What they didn't realize was that the normal system parameters they were monitoring were themselves flawed. Over the first 6 months, Aaron accumulated $28,700 in promotional credits, far more than his theoretical loss from actual gaming would have justified. But each credit had been awarded by the casino's automated systems following their own formulas. He redeemed credits gradually, converting them to cash at rates that didn't trigger review thresholds. He lived frugally, maintaining his student apartment, continuing his night school courses, and building savings from the systematic extraction. By month 9, he had refined his approach to maximize efficiency. He identified optimal machine positions, time periods with minimal staff supervision, and redemption patterns that stayed below attention thresholds. He had essentially turned exploiting the rounding error into a well-paid job that he performed with accounting precision. And the casino's systems continued showing green indicators because nothing Aaron was doing violated any rule. He was simply playing games, earning promotional credits the system awarded him, and redeeming those credits as the casino's published policies allowed. The rounding error was invisible to automated monitoring because it manifested as micro discrepancies across millions of transactions. No single transaction was wrong enough to trigger alerts. The error only became visible when someone aggregated all transactions over time and compared cumulative promotional awards to theoretical models. But the casino's reconciliation systems didn't perform that kind of aggregate analysis. They assumed their promotional formulas were correct and that any variance was normal statistical noise. By month 12, Aaron's cumulative promotional earnings exceeded $150,000. By month 14, he had crossed $49,000. Aaron's escalation from thousands to millions didn't happen through gambling success or dramatic risk-taking. It happened through a secondary discovery about how the casino's tiered rewards program interacted with the base rounding error. In month 7, Aaron had been promoted to the casino's mid-tier reward status, Gold Member, based on his cumulative play volume. This status granted him a higher promotional earning rate. Instead of earning base rate of 0.35% of theoretical loss as grand points, Gold members earn 0.42%. The percentage increase seemed modest, 7 basis points. But Aaron immediately recognized what this meant for the rounding error. The higher promotional rate meant more transactions would generate fractional grand point values that triggered the rounding error. Instead of perhaps 40% of transactions producing rounding benefits, now perhaps 60% did. The promotional awards increased, not just from the higher base rate, but from the increased frequency of beneficial rounding. Aaron ran the calculations. If he maintained his play pattern and earned the next tier, Platinum Member, offering 0.52% promotional rate, the compounding would accelerate further. He began playing additional hours to qualify for tier advancement, treating the casino's rewards program like a game with published rules that could be optimized through mathematical analysis. When he reached platinum status in month 10, his promotional earnings jumped significantly, not from gambling better, but from triggering the rounding error more frequently at higher transaction volumes and higher promotional rates. The casino's tiered system was designed to encourage loyal, high-value play by offering better rewards to players who wagered more. But it had been designed assuming the promotional calculations were mathematically sound. The system hadn't accounted for what would happen if someone discovered that the promotional calculations had a systematic error, and that higher tiers amplified that error by increasing the frequency of fractional values that triggered beneficial rounding. Aaron was essentially collecting compound interest on a mathematical mistake, and because each grand point was awarded by the casino's own systems, documented in their databases, and redeemable according to their published policies, there was no fraud in the traditional sense. He was just someone who had noticed that if you played the system exactly as designed, with sufficient volume and discipline, it paid out more than it theoretically should. By month 14, when Emily Chen's curiosity audit finally discovered the aggregate discrepancy, Aaron had redeemed promotional credits totaling $49,000, all properly documented, all authorized by automated systems, all seemingly compliant with the casino's own rules. When Emily Chen brought the $49 million discrepancy to senior management, the immediate reaction was disbelief followed by urgent damage control. External forensic accountants were brought in. The casino systems were audited comprehensively. Every transaction associated with Aaron Liu's player accounts was reviewed in detail. What they found was both simple and devastating. The promotional calculation system had been rounding values incorrectly for years, awarding fractional grand points that shouldn't have been awarded based on strict mathematical accuracy. The error was in how the system handled decimal precision during a specific step in the multi-stage calculation process. On any single transaction, the overpayment was 0.01 or less. Across millions of transactions by thousands of players, the aggregate overpayment was probably in the hundreds of thousands of dollars annually, a small percentage of total promotional spend that fell within the statistical noise range that no one thought to question. But Aaron Liu had apparently discovered the error and exploited it with systematic discipline that turned barely meaningful micro-discrepancies into massive cumulative overpayments. He found a bug in our math, the casino's CTO explained during an emergency board meeting. Not a security flaw, not a rule violation, a mathematical error in how our promotional system calculated awards, and he built his entire playing strategy around maximizing how often that error occurred. The legal challenge was profound. Aaron hadn't hacked anything, hadn't colluded with employees, hadn't used devices or marked cards or any prohibited method. He had simply played games according to posted rules, earned promotional credits that the casino's own systems awarded him, and redeemed those credits as casino policies allowed. Every grand point he'd earned was documented in transaction logs. Every redemption was approved by automated systems following established protocols. Every credit he'd received had been calculated by the casino's own software. How do you prosecute someone for exploiting an error in your own mathematical systems? How do you claim theft when you gave someone money your systems calculated they had earned, even if those calculations were wrong? The casino's legal team spent weeks analyzing whether Aaron's actions constituted fraud, theft, or breach of terms of service. They concluded that while he had clearly exploited a system flaw, he had technically not violated any posted rule or policy. He had discovered that if you played the games exactly as designed, with sufficient volume, the promotional system overpaid, and he had organized his playing activity to maximize that overpayment. It's like someone discovering that a bank's interest calculation has a rounding error that benefits depositors, then opening thousands of accounts to exploit it, one attorney explained. Is that fraud, or is that just being more careful about math than the bank was? The investigation revealed that Aaron had withdrawn his $49 million gradually over 14 months, converting grand points to cash through redemptions that individually fell below escalation thresholds. By the time the aggregate amount was discovered, the money had been withdrawn, properly documented, and paid out according to the casino's own authorization processes. Aurora Grand immediately fixed the rounding error in their promotional calculation system. They implemented new audit procedures to detect systematic exploitation patterns. They revised their terms of service to explicitly prohibit exploitation of mathematical or technical errors. But they couldn't recover the $49 million, and they couldn't prosecute Aaron Liu for discovering that their math was wrong. When investigators finally located Aaron Liu for questioning, 3 weeks after Emily Chen's discovery, they found him completing final exams for his associate degree in accounting. He agreed to meet with casino investigators and law enforcement voluntarily, arriving at the interview with a detailed spreadsheet documenting every transaction, every promotional credit earned, and every redemption made over 14 months. I tracked everything, Aaron told the assembled investigators, his voice steady and professional. Every hand played, every grand point earned, every calculation performed by your systems. I have receipts for every redemption, documentation for every transaction. Everything was authorized by Aurora Grand's own systems, following their published formulas. When asked if he had known the promotional calculations were incorrect, Aaron's response was carefully worded. I noticed that the grand points I was earning didn't match what I calculated the theoretical amount should be based on published promotional rates. I assumed your systems were correct and my calculations were wrong. Your systems kept awarding me promotional credits. I kept redeeming them as your policies allowed. Did you understand you were being overpaid? An investigator asked. I understood there was a discrepancy between my theoretical calculations and your system's calculations. I didn't know which was correct. Your systems are professionally designed and maintained. My calculations were just based on formulas from accounting textbooks. I trusted your systems over my math. The response was technically accurate and legally defensible. The interview lasted 3 hours. Aaron answered every question with accounting precision, providing documentation for everything. He never claimed ignorance. He clearly understood the mathematical principles involved, but he maintained that he had followed all posted rules, played games as designed, and redeemed promotional credits that the casino systems had awarded him. When investigators asked what he had done with the $49 million, Aaron provided bank statements and tax documentation. He had paid off his student loans, $18,000. He had paid off his credit cards, $3,200. He had purchased a reliable used car, $12,000. He had established savings and investment accounts, amounts he declined to specify, citing privacy. He had paid taxes on all promotional redemptions, treating them as miscellaneous income and filing proper returns with the IRS. I documented everything for tax purposes, Aaron explained. Grand points redeemed for cash are taxable income. I kept detailed records. The investigators found themselves in the unusual position of interviewing someone who had apparently committed what could be described as the largest theft in the casino's history, but who had documented everything so thoroughly and followed tax law so carefully that building a criminal case seemed impossible. Aaron graduated with his associate degree in accounting 3 days after the interview. He attended the graduation ceremony, received his diploma, and declined to participate in any media interviews about the Aurora Grand situation. He disappeared from public records shortly afterward. The Aurora Grand Casino's internal investigation, completed 6 months after Emily Chen's discovery, concluded with findings that were both technically comprehensive and deeply uncomfortable for everyone involved. The rounding error in the promotional calculation system had existed since the software was implemented 8 years earlier. It had been reviewed by auditors, approved by regulators, and trusted by financial controllers as mathematically sound. Nobody had ever verified the calculations by hand. Nobody had compared aggregate promotional awards to theoretical models. Nobody had questioned whether the system was rounding correctly. The system balanced itself. The promotional spend each month fell within budgeted ranges. The variance from theoretical models seemed like normal statistical noise. The error had cost Aurora Grand approximately $1.2 million annually in aggregate overpayments to all players before Aaron Liu discovered it. That amount was material but not alarming. Roughly 2% of total promotional budget, well within the unexplained variance range that financial controllers attributed to random factors. Aaron's systematic exploitation had cost them $49 million over 14 months, not because he had found a way to cheat, but because he had found a way to maximize exposure to an error that was always present. The system trusted its own calculations, the final report concluded. Automated reconciliation assumed accuracy, because nothing appeared obviously wrong on individual transactions. The aggregate discrepancy was only visible when someone specifically looked for systematic patterns across millions of transactions. Mr. Liu apparently discovered the error through careful observation, understood how to exploit it through high-volume, low-stakes play, and executed his strategy with accounting discipline rather than gambling instinct. The report made 17 recommendations for improving mathematical verification in promotional systems, implementing aggregate-level auditing, and detecting exploitation patterns. It did not recommend prosecution, noting that Mr. Liu's actions, while exploitative of a system flaw, did not violate any posted rules, and every promotional credit he received was properly authorized by Aurora Grand systems. The casino settled quietly with insurance carriers, implemented the recommended changes, and moved forward. But the case became legendary in casino industry circles as an example of what could happen when sophisticated systems went unverified. Not because of hacking or insider fraud, but because someone with accounting training simply looked carefully enough to notice that the math didn't work correctly.